Bring in Gil Luria, senior software analyst at DA Davidson. Gil, based on how you're slicing it, what should you do with the stock here?
Oh, we continue to think that Shopify is a long-term winner. The pullback today, just to put it in context, the stock is up almost 100% since a year ago, and it was up about 10% from a week ago. So all we're doing today really is giving up a week's worth of gains. To Paul's point, the guidance outlook wasn't as high as some investors expected, especially the ones that bought over the last week with expectations that Shopify would guide for as well as it did in 2023. 2023 was an unusually good year. They wrapped up the year in Q4 growing revenue by 30% while reducing expenses by 22%. That's very hard to replicate. In 2024, we're going to go to more of a sustainable mode of 20s growth, mid to high 20s growth, and expenses will grow slower than revenue, meaning margins will expand, but not at the same rate as last year.
And I think that's another anxiety point on a day like today, and contrast it with like Facebook, when they said they're going to spend, the market was in a mood to hear that information. Do you think ultimately the market is going to come around to Shopify spending intentions for this year?
It will, because Shopify has both sustainable revenue growth and margin expansion ability for years to come. The secular growth behind e-commerce isn't changing. Their ability to gain market share by going up market isn't changing. Their ability to gain wallet share by increasing the penetration of payments and other products isn't changing. And while they do all that, they have shown an inclination to be disciplined on costs. Now, mind you, they're not going to cut 20% of headcount as they did a year ago anymore, but they'll grow it slower than they're growing the revenue. And again, that's sustainable for years to come.
The market is obviously in a foul mood for other reasons, the inflation picture and the reduced expectation of rate cuts. How do you imagine that to show up in your coverage universe that is software, but includes, top dogs like Nvidia, Salesforce, Amazon? I mean, some of these stocks that are responsible for the broad market gains.
I think this year the burden of proof is on these companies. Most of these companies performed phenomenally well over the last year or so, and including year to date. Now they have to deliver. They have to deliver accelerating growth, or they have to deliver very concrete proof points that they're benefiting from the major trend around artificial intelligence. Companies that won't be able to do that are going to have a very hard time continuing to sustain higher multiples and sustain the performance they've had recently, because investors need that to happen, need accelerated growth in order to justify high multiples.
Let's talk about Datadog, because that's another stock that you cover. You talk multiples. This one is quadruple digits on current estimates, which I know is not always fair. But it's also getting clipped here. This is kind of, and it's taking down some of the other stocks in the sector. But the growth, right? It's still double digits. It's not like growth is imploding.
Well, the multiple is very high. Even on a revenue basis, it's close to 15 times revenue, which is among the highest in software, even though they guided for only 20% growth. This is a company that a couple of years ago was growing 60%. Last year decelerating more into this year. And so that's why there's some investor trepidation. And there's another company in the same monitoring observability sector, Dynatrace, that guided for the same level of revenue growth and is trading at a significantly lower multiple. And so investors today are balking at paying such a high multiple for a company whose growth is decelerating significantly this year.
Well, I got to get your last thoughts on Nvidia, because this just you can't seem to knock this one off its game. It's a little bit lower now, but it did spend most of the session higher and near those records, up 50% so far in 2024. Gil, you're neutral on the stock. The proof's going to be in the pudding next week, right, on earnings. What are you anticipating?
It's a tale of two stories here. In the short term, Nvidia is doing phenomenally well. We just heard the biggest companies in the world Microsoft, Amazon, Meta, and Google say they can't buy enough GPUs. They will buy a lot of GPUs this year. And that's why the report next week should be fantastic. The reports for the rest of the year should be really good. The question will start being, are out-year estimates reasonable? We think out-year estimates, meaning even 2025, 26, are way too high. This is not a sustainable level of purchasing for these large companies. They're just stocking up. They use the word, we are accelerating CapEx. They're buying as many GPUs as they can right now with the notion that once they have enough, they won't have to buy them again next year. So tale of two stories. Short term should be great. As we go into the out years and estimates get out of hand, we should be a little more cautious.